Thursday, the 7th of September. Hope you had a good evening. Just recapping then of some of the major news that we've had really that occurred late yesterday, and then how that sets the scene for the upcoming events, most notably the ECB press conference we'll get later on this afternoon. But having a look at things this morning, you can see there's relative calm in the market. There's obviously not been any of those kind of headline issues that were really impacting risk sentiment that were very clearly apparent last week, which was North Korea. It's been fairly quiet on that front, actually, I'd say, other than, I say quiet, other than the fact that reports continue to circulate about the fact that North Korea may well test fire another missile on September the 9th, but other than that, it's business as usual in terms of dealing with Korea. But looking at the close on Wall Street, it was actually a positive close across all three major indices. And that kind of fed through into the Asia-Pacific region. And so if you're looking at the DAX and EURUSD this morning, we are up in minor positive territory following that. So the S&P was up 0.3, Dow 0.25%, and the Nasdaq up a similar margin. Now, where did this positivity come from, albeit fairly moderate? Well, there's a couple of key issues that we need to cover. And starting off with the debt ceiling. And obviously this has been a real contentious issue, given the fact that really we hadn't heard too much on this given the summer recess, but this week, obviously after the Labor Day holiday, US politicians returning to Capitol Hill, and the first topic on the agenda, if you like, to deal with was the looming debt ceiling, with the risk of a government shutdown that may have occurred come October. Well, this has now been averted, at least for now, that is, because this was the headline and the corresponding market moves which happened last night. A temporary debt ceiling deal ripples through the T-bill market. So for those not familiar with the kind of maturities, when we're talking T-bills, we're talking shorter dated debt. So 3 month, 6 month type periods, rather than your benchmark 10-year T-note, for example, your government bonds. So much shorter dated debt. What's happened here is a deal between President Trump and Democratic leaders in Congress to temporarily lift the debt ceiling going through short-term government debt. So Mr. Trump agreed with the Democrats that a short-term extension of federal borrowing authority should be paired with a measure to fund the government and provide aid to Hurricane Harvey's relief efforts. This was one of those things that we were talking about the risk of a government shutdown had become smaller because of the fact that a lot of these politicians were talking about rolling in the short-term funding to help the victims of the Hurricane Harvey on the Texan coast in with a short-term stopgap for the looming government debt ceiling. The deal means that this now will run through, so basically the government can fund itself up to, though, only a specific date. And this date is actually quite important, because the deal would run through to December the 15th, alleviate pressures then on Congress to raise the debt ceiling or face the risk of missing payments on those short-term Treasury bills, as we said early in October. But December the 15th is important. Can anyone tell me why in the chat room? Why specifically the 15th is important? You got 5 seconds. Okay, Inga, thank you very much. I can always rely on you. That's right, you've got a Fed meeting. The Fed meeting is happening as ever, 2-day meeting, with the announcement of their discussion on the 13th. So 2 days before the debt ceiling is going to expire again, you've got a Federal Reserve meeting, and of which the market is expecting that if there is going to be a Fed rate hike, then that's the month when they're going to pull the trigger. Is this going to then really complicate the Fed's ability, given the uncertainty that I'm sure that will come back, like what we've had in the last few weeks about the debt ceiling again? Trying to get a deal done usually goes up to the last minute. And so is that going to influence then the Fed's ability to be able to follow through with their kind of commitment to hike rates one more time by the end of the year? So a lot of the people talking this morning, this is a bit of a can kicking down the road exercise. Granted, at the moment, this is a positive short-term intraday, but long-term, this just means that we forget about it. It's resolved for now, but we will revisit this again in 3 months' time, and then it will become an issue again. But as far as, remember, market focus is concerned, one of the key risk kind of blocks, if you like, has now moved down the hierarchy of importance. One thing then that happened quite clearly yesterday was really sharp movement in the short end of the yield curve, and this is where we saw distinct changes in the yields of the October T-bills against the December T-bills. So what you can see here is the October T-bill, the blue line, the yield dropped substantially. That's because now there isn't any risk. The government can go ahead and continue to fund itself. On the flip side though, this reflects then now the growing danger of holding debt that's due to expire on the 21st specifically of December, because that obviously encapsulates then the 15th of when it's going to, the government's going to run out of money again. So obviously the yield has had to leap higher in respect to the risk of holding that specific maturity of debt. So quite an interesting chart to show that in reality. And certainly this was a key trading event if you were trading the short end. A good picture I saw this morning in the FT. This is a picture of Senate Minority Leader Chuck Schumer wagging a finger in Trump's face like he's about to whack him. And this is quite interesting, and actually I think this does have some read across in terms of trying to have some sort of sense on how the president is going to act, because House Speaker Paul Ryan, House Majority Leader Kevin McCarthy, and Senate Majority Leader Mitch McConnell urged the president not to agree to a short-term solution to raise the debt limit. But the president backed the Democrats, the opposing party's proposal for a 3-month extension, something Paul Ryan called earlier in the day ridiculous. So basically, your three most other senior Republicans within your party, you've gone, do you know what? You don't know what you're talking about. I'm going to side with the opposition party. How do you like that? I'm the President of the United States. Doesn't surprise me, because it's Trump, and we know that he tends to be a man that will follow his own kind of path, so to speak, and make his own decisions. But the one thing, obviously, this does has repercussions on is the other members within his team and his advisory panel to actually help and assist him and give him these other alternate arguments, because he's basically gone against the board. If you think about, let's say, a central bank structure, you have hawks, you have doves. You have the same really with politicians. Hawks, fiscal hawks, and so on and so forth. But what's happened here is, in a normal circumstance, the leader, the chairman, the president would normally take the majority view. That's the whole purpose of having a board. Whereas in this case, irrespective of their arguments, he's superseding, which I think is quite an important thing going forward, to know that this kind of situation could reoccur on other subjects, regardless of his advisory team and what they tell him. Stephen Mnuchin, the Treasury Secretary, urging Congress then to raise the debt ceiling to avoid that default. And Republicans had wanted to pass a bill to push the next fight on the limit beyond the November 2018 midterm election, which makes strategic political sense. Why not agree till after the midterms so that this issue does not then affect the voting electorate when it comes to the midterms? And so I can see their strategy, but obviously Trump is just wanted to get a deal done short term. This was the other big thing actually that occurred yesterday, and this happened just after we left the markets. European markets had closed at this point, This was a headline in the Wall Street Journal. President Trump unlikely to nominate Gary Cohn to become the Fed chairman. Cohn's chances dropped after he had criticized Trump's response to the Charlottesville protests, according to people familiar with the president's thinking. Now, as far as how the financial markets react to this specific story, well, Cohn is actually someone within the Trump administration that the markets respect. And actually, they value his opinion and his position of influence. The fact that he was potentially going to be the Fed chair, I was seen as probably more of a positive development compared to other members that potentially could have been put into place. But it looks like someone who was touted pre-Charlottesville as pretty much a shoo-in for the role, now because of his criticism of the president now, according to inside sources, is extremely unlikely to nominate him now as the next Fed chair. Now, this does bring about some really interesting things here, because we know Janet Yellen's term is expected to, or is due to expire shortly. Whether or not she stays is a little bit of a toss-up at the moment. Trump has changed his mind on several occasions on whether he does like or not like the type of policy that Yellen has been governing. The other thing that happened last night, so it's been, we haven't had to wait for long to get over the summer lull, is that the Fed's vice chairman, so you're talking about Yellen, who's the Fed chair, and now the vice chairman, Stanley Fischer, has said yesterday he will resign in mid-October for personal reasons. Now, this is very important, and this is what I just want to quickly explain the structure of the Federal Reserve governors. Because what happens now is that if Yellen and Fischer, let's say, were both to be removed, that means it's another vacancy to the 3 others on the powerful 7-member Fed Board of Governors. This probably might not make much sense to some of the interns, so let me explain with this infographic. Now, this infographic is old. I mean, it is from last year, so there has been changes in the personnel in terms of voting rights and so on and so forth. Just think of this as the structure, though, is what I want you to look at. The important thing here is it's divided into 2 distinct separate sections beneath that of the chairman, or the chairperson, Janet Yellen. On the left, you have the Board of Governors. Then on the right, you have the district presidents, divided on a rotationary basis between voting and non-voting members. Much like the ECB, you have the Executive Council, and then you have the ECB Board of Governing Members. So say for Italy, for example, Italy will have Visco as the head of the central bank in Italy, but they'll also have Mario Draghi, who's the president. Portugal will have 2. There's the head of the local central bank, the national central bank, and then there's also Victor Constanzo, who's the vice president. So there's a divide there. Now, the important thing here is that if basically Yellen goes, Fischer goes, and there is also other slots there at the moment, it means that there's only going to be what normally, if fully filled, should be 7 Board of Governor members. There will only be 3. This, you would think, could be quite worrying, because the whole basis of this idea is to have a dichotomy of different views in order to have a balanced assessment about the economy. When you're down to 3 people, you would feel that maybe this is getting a little bit pressured on those, and the actual ability to have dovish and hawkish views starts to dissipate depending on the low numbers or the people who are present. So this is why this is key. Going forward then, we will need to keep a close ear out for who is it that Trump's going to pick, because the one thing that financial markets do not like is they do not like uncertainty. And at this present point in time, Yellen is looking likely that she will not be reappointed. Cohn is now out of the picture. There is no next person that's kind of favoured to take the position. And we're going to have to, or I say Trump and his team are going to have to find someone and elect them over the coming months. So it's a pretty short time frame. Yeah, this is just what I was looking at here. So who participates in the board of governors? And if you take out the top two, which are the most senior, i.e. the chair and vice chair, then you're left. This is the current structure of the board of governors as of 2017. You've got Brainard, Powell and Torillo is who you're left with. Okay, moving on. Let's have a look at something else. Just while I'm talking, I can see of the last kind of half an hour or so, the Euros had a little squeeze on the upside, managing to just get above some of the high print that we had from yesterday. If I start stretching the chart out a little bit here, you've got, presumably that would be the payroll high when the dollar originally, in the immediate knee-jerk reaction, spiked lower on the negative read across on the initial numbers, and euro-dollar popped up. But if we continue above here, as in terms of the daily range, depending on what Draghi says, then you can't discount 120.82.5 under the right fundamental conditions. But what is it that we're expecting? Well, Draghi kicks off the QE exit debate. He has a long sought to avoid. What we're talking about here, of course, is about when are we going to get the details as to the timing of starting to taper down the size of quantitative easing going forward. So a couple things to look at here, and that is, well, first of all, let's have a look at the euro area economy. It has gained momentum this year. Euro area GDP growth, if you look at it in terms of the most recent reading, we're at the best, certainly what we can see here on this chart, going back to the end of 2014. And if you're looking at the composite PMIs, well, even they're up at the best levels we've been in several years. Just thinking of the likes of the French manufacturing PMI that we had just last week, 6.5-year high, for example. Economic conditions is what's lent Draghi to be able to change the tone, really, since that centrist speech we had back in June, to sound more optimistic about the European economy and its prospects, and therefore the need to start unwinding such a loose monetary policy, i.e. QE. So if you remember, if I identify when that centrist speech was, roughly, so we're kind of going back to late June, it was around here, that was the trigger point for the next big push up that we had in the euro-dollar pair. You can see we got above some key levels, that 2016 high, gone above the 2015 high, which has acted as a bit of a floor for support for keeping us up at around this 120 level. So the story of the euro has been the market's expectation that tightening is on its way. The question mark then is when. Now, one of the things with the ECB QE program that I wanted to look at was this. This was the last ECB interest rate decision. And so remember, this is a two-part event. You have 12:45, the initial interest rate decision, where they also released this statement. This was the statement they released back on the 20th of July. And then at 1:30, and arguably specifically for today, the press conference will begin, which normally lasts for about 20 minutes, him delivering a speech, and then about 40 minutes for a Q&A with the press in attendance. So the 1:30 is really going to be key. But this first section of the release is twofold. This initial statement. Part one is you get the interest rate decision for the three key rates, i.e. the refi rate, 0, the marginal rate, 25 basis points, and the deposit rate, which of course is negative 0.4% at the moment. The second part of this, and the important part here, is the second paragraph, which talks specifically about the quantitative easing program. Now, as you know, the current monthly purchase pace is 60 billion. Now, this is the key here. We're not looking for this to change today, but just giving you some context. The current monthly pace of 60 billion intended to run until the end of 2017, so December 2017, or beyond if necessary, and in any case until the Governing Council sees a sustained adjustment in the path of inflation consistent with its inflation aim. Now, going back to inflation, as you know, as defined in this picture, inflation, if anything, has been below target. Headline inflation got close. It actually touched it back at the beginning of the year. It's dropped away from there before then stabilizing again. But albeit, headline and core are tracking quite substantially below target. So the expectation is that eventually, and most people are looking toward the end of October for this possibly to happen, if not in December, that they will make this number smaller, i.e. 40 billion, and increase this timeline further out, i.e. commit beyond then going well into 2018, because we haven't seen this adjustment in the path of inflation become consistent as yet. So that's the kind of broader picture. For today though, not expecting any change here, and we're not expecting any change here. Where the change is going to come, of course, is what does he say during the press conference. Now, some of you might not have been around or watching the markets last night, but at around 5:30, there was a brand new Bloomberg ECB source story that came out. Now, I think the chart that Philippe had up yesterday is still here. Okay, so this is a minute chart of what Eurodollar's reaction was. Well, let me get the precise timing. Actually, it was 17 minutes past 5 last night. There was a Bloomberg ECB source comment came out, Eurodollar popped lower and then started to recover. So this is what I'm looking at here. Spiked down and then it came all the way back up and steadied back to exactly where we were in just a few minutes time frame. Now, why was this? Well, these were the comments. And specifically want to draw your attention to the first one. ECB draft forecasts are said to cut 2018-19 inflation slightly. One of the important things that you need to realize with the press conference today of the ECB is, irrespective of the QE talk, part of the way to get a bit of an indirect insight as to what they might do with that is the fact that they're going to be releasing GDP, latest ECB forecasts for GDP and, importantly, inflation. And so what this source has done is basically told you what they're going to do today. And I think this is pretty much baked into most market consensus, is to look for a slight downgrade to inflation for 2018-19. The question mark will be, and how much the euro will react, is to how much does it get cut. Or, if it doesn't get cut at all, given the sources have prepped the market for this event, and for that to materialize, then the euro should rally. But I would say the way that these things work is these source comments have come from the ECB. They're not made up. This is the kind of off-the-record way of the central bank communicating to the market of a forthcoming event, and so that when it occurs, they are managing price stability, kind of volatility in the market. The other key thing here, and this is a repetition very much of what we had, if you remember, if I go back to, well, let's go back to the other chart, and let's just go back to payrolls for a second. So where was the payroll move? Okay, let's zoom it in a little bit. Yeah, this is what I'm talking about here, this move. So just adjusting my charts. This obviously was non-farm payrolls when it came out, and this was chiefly led by the dollar weakness on the all-round first reaction to the miss on the headline, unemployment rate ticked up, negative net revisions, lower wage data, so on. Eurodollar exploded to the upside. Then something very important happened right here. Exactly 10 minutes after, the entire move reversed immediately and then some. And of course, this was because, and we heard the exact same thing repeated in last night's ECB sources, was the ECB is said to be unlikely to reach QE decision before October 26th. That was the main reason why the euro weakened so much late Friday. It's because of the complexity of actually then tapering down on their QE program, means that they might not be ready until December. And so it's these kind of hints towards timings that we're going to be keenly looking for today. The other big thing, of course, to define what it is or to build a parameter of expectation of when the ECB might act is this chart. We've looked at it before, but I thought I'd recap it given today's event, and that is, how does Draghi react to the present exchange rate in the press conference? Now, last time out, wasn't too much said, but the big question marks here are about mild verbal warnings about the euro exchange rate. Is it deemed to be important or significant to things like inflation? You can see that depending on where the level of the euro is, the blue line, it determines the type of wording that is used. So as you can see, when the euro before has been considerably higher, so going back much longer in time, then words like important, very important start to be used. Whereas most recently, it's more been market forces, some attention. But if he starts to say it is a very important part of the equation, then people will be factoring that into how hawkish or dovish the tone is in the accompanying speech. Okay, let's take a different tact and then wrap things up. This is looking at oil. Oil has been very interesting. So looking at the chart, firstly, where we are at the moment this morning, it continues to make some headway on the upside. It's been a bit of a slow burner, but certainly from a trend perspective, the price of crude does continue to make its way north. You can see here, these were the previous levels of significance we were looking at yesterday, was that 18th and 21st high. You can see how we pretty much tested that. Reason these levels are important because it also brings into play that $49 handle. And then you can see it test, came all the way back down before then the eventual break, again using it as a floor for the push up to what was yesterday, I believe the R1 level. And now we're just finding some support right on the $49 handle, which presumably on the intraday is the pivot level, or there or thereabouts at 49.03. So just looking at crude this morning, obviously keeping an eye on yesterday's high print. It's not too far away, 49.42, R1 54, and then ahead of what would be the high print that was seen really going back to late July, early August. You've got to surmount the $50 handle, which is quite a big, obviously, psychological barrier on the upside. But trend of oil has been higher, and there's a couple things to be aware of, though, going forward. And this is the type of headlines that we're seeing this morning. They were talking about some of the overnight session, where we were slightly negative. But fears Hurricane Irma could hit crude shipments and rising Libyan output. But it is a bit of a balanced story here. So, fears that Hurricane Irma in the Caribbean could interrupt crude shipments in and out of the United States, and as Libyan output began to recover from disruptions. Remember, there's been a lot of civil unrest in Libya that's been to their detriment in terms of their ability to be able to produce anywhere near capacity. Hence the reason why they've not been capped as part of the OPEC agreement. However, prices have received some support from rising demand in the US, where Gulf Coast refineries are restarting in the wake of Hurricane Harvey. So remember what we had when Harvey originally hit last week. This was all about weakness in oil and strength in gasoline, on the back of the fact that, well, actually if these refineries are down, well then there's no need to demand the raw crude product because we can't refine it. So lack of demand saw crude drop. Now as these refineries come back online, they can process again in the Texas coast, which means they need that oil demand back from the offshore facilities, from the actual oil wells and platforms, so forth. So you've got a complete reversal now as a modicum of reality returns to that specific area on the Gulf Coast, or Gulf of Mexico. Now, talking of Hurricane Harvey and its impact, we did have the API crude oil inventories last night. Now, just looking at the reaction to that, I must say it was absolutely zero. Zero reaction. Why? Because what do you think these numbers would have come out as? Of course, there is a extremely large build in the crude number. We know this. Oil already went down last week. This is why the markets, remember, are priced on future expectations. That's why the market sold off so much last week. So the fact that the crude headline was a build, the biggest in 5 months at 2.79 million, was completely taken in the stride by the market. Gasoline, again, no surprise at all. Gasoline was massively bid up because of the fears of the impact of Harvey, and so we had a big drawdown of 2.544 million. So you got the DOEs later on this afternoon, as per usual. You're going to have to be monitoring that later, and it's probably going to be several weeks ongoing that the Harvey impact will continue to be apparent within these figures. Okay, last piece of news, and then we'll look at the calendar. This is turning our attention back to the UK. Not going to talk about it for too long because the pound is definitely not reacting at the moment, but it could do later, hypothetically, because Theresa May's flagship piece of Brexit legislation is going to be debated for the first time today, which obviously gives opponents an opportunity to lay out their objections in Parliament. So the question mark is, can they derail the government's plans? And so listening out for opposition commentary as Davis appeals to opponents ahead of a second reading in the Commons is something just to be aware of for any sterling traders. Okay, so calendar for today. The morning is going to be very quiet. Actually, I did notice the Halifax house price data, quite surprisingly actually. We had a quite a bit stronger than expected number. Month on month Halifax house prices, after what has been a pattern of decreasing house purchase appetite, actually went up 1.1% against 0.2. So Sam North, if you're listening, you need to pull the trigger quickly if you're going to get that flat. Otherwise, going forward, as I said, you've got the ECB, you've got the rate decision coming at 12:45, and then you've got the press conference, which is arguably the main event for today. And that'll be at 1:30. So what I would say is that just be a little bit, unless an opportunity strongly presents itself, whether a technically sound level or a piece of unscheduled news breaks that moves the market, you might be better served saving your ammunition for the bigger event to come at 1:30, which will probably provide you with the greatest trade opportunity from an intraday basis. That'll be alongside when the conference begins, the weekly jobs data, but you can pretty much scrap that, forget about it. The market's going to be focused on Draghi and the upcoming speech. And then remember, for the DOE oil inventories, due to the Labor Day holiday on Monday, then they will come out at 4 p.m, not the regular time of 3:30. This is always the case when there has been delayed by a day due to a US market holiday. Okay guys, that's your morning briefing. Any questions, please feel free to speak to me in the chat room. Happy to help. Otherwise, have a good day and good luck for the ECB.